Chapter 14, Capital Budgeting Decisions. So think about a company that has to make decisions on different type of projects. Can we expand the actual plant? What about equipment selection? We're trying to determine what type of equipment we should purchase, or it could be the replacement of equipment. Cost reduction. How can we reduce our operating expenses? Should we lease these vehicles or should we buy these vehicles? Should I lease the equipment or should I buy the equipment? These are all different type of capital budgeting decisions that a company has to make. Now, typically, capital budgeting falls into two broad categories, what we call a screening decisions and a preference decision. Screening says, does a proposed project meet some present standard of acceptance? So we're saying here is that, okay, I want a 10% return on any project. That could be the actual standard. So does a proposed project meet some present standard of acceptance? If it does, then we have a preference decision. So we may have several options to choose from. So selecting from among several competing courses of action. So we're saying that, okay, these 5 projects do meet our criteria. They pass the screening decision. However, we can't do all 5, we can only do 1. So we have to rank those 5 to determine what would be the best course of action to take for our business. So there's different ways we can focus on these capital budget decisions. We look at our cash flow, the actual cash coming in versus what's known as operating income. When you think about your operating income, that's the actual revenue that's going to be earned from this business decision. Okay, so we'll look at different methods such as the payback method, the net present value approach, and the internal rate of return. These different options focus on the cash flows associated with capital investment projects. So if we're trying to expand operations, if we want to purchase new equipment, we'll look at the cash flows involved in these different capital investment projects. Okay? We'll also look at a little later what's called the simple rate of return, which focus on incremental net operating income. So it's an entire chapter about capital budgeting decision and different methods we can take a look at to help us pick the project that's going to meet our objectives. Let's talk about typical cash outflows. Typical cash outflows. So let's say we're looking at equipment. There's an initial investment cost for the equipment. There's working capital, money needed for those employees who provide the actual services. There's going to be incremental operating costs as well as repairs and maintenance. So these are the typical cash outflows you're going to have with any project: repairs and maintenance, the initial investment, your operating costs, as well as your working capital. Next, we look at the typical cash inflows. So when we buy this new equipment, there can be a reduction of costs. That's a cost saving. Release of working capital once that project has been completed. Incremental revenue, the money coming in from this project. And then we have what's known as salvage value. So we're saying that if I was to purchase new equipment and sell the old equipment, salvage value says this is how much I can get for that old equipment. So these are a typical cash inflows associated with any type of initial investment project. Now, we're going to focus on the time value of money concept. $1 today is worth more than $1 a year from now. And that's true. because of things such as inflation. What costs $1 today may cost $1.10 a year from now. So we have to look at the time value of money concept when we're trying to make a decision on which projects we're going to accept and which ones do we prefer over other projects. So those projects that promise a early returns are preferred to those that promise later return. So if one project says my return on investment will take place in 3 years, whereas the other says it will take 5 years, all other things being considered equal, I'll probably choose that project with a shorter payback period because of the time value of money concept. Okay? The capital budgeting technique that we're going to focus on the time value of money that's going to be involved. We're going to discount the cash flows. What does that mean? Well, for each of these projects, we're going to look at what is our required rate of return. And we understand that these cash flows are coming in over a period of time. The amounts may be $10,000 each year for the next 5 years. However, $10,000 received 5 years from now is different than $10,000 received today. So we'll look at what we call a discounted rate to discount these cash flows using the capital budgeting techniques. Okay, let's get into it. The first approach we're going to look at when determining which projects to accept, we'll take a look at the payback period for an investment. The payback period for an investment. What the payback method focuses on, the length of time it takes to recoup the cost of the cash receipts from the project. So we're looking at the initial cash outflow for this particular project, and we're saying how long will it take us to recoup the initial cost out of the cash receipts that's being generated. So if this project is going to cost us $10,000, but we're going to recoup $2,000 each year, we'll look to see how long will it take us to recoup the entire cost. That's known as the payback period. So we have a formula for the payback period. It is the investment required divided by the annual net cash inflows. So write down that formula. It is the investment required divided by the annual net cash inflows. One thing to take under consideration, the payback method does not consider the time value of money, meaning that with the payback period, we're not looking at the present value of those cash inflows, just the amount of the annual cash inflows. So we'll talk more about the payback period and how to use this approach to determine which investments we're going to accept, which projects we're going to reject. Here we go. So you ready? Management at the Daily Grind wants to install a new espresso bar in its restaurant. The cost is $140,000 and it has a 10-year life. The express bar would generate annual net cash inflows of $35,000. Notice it says net cash inflows. So that's cash inflows minus cash outflows. So the net cash inflows would be $35,000 per year. We require a payback period of 5 years or less on all investment, meaning that if we can't recoup all of our costs within 5 years or less, we're going to reject that particular project. So we're saying, what is the payback period for the espresso bar? So we'll take the cost, $140,000, divided by the annual net cash inflows, and that would give us a payback period of 4 years. So we're saying we can recoup the investment required within a 4-year period. And since our criteria is recouped within 5 years or less, this project does meet our criteria. So we may decide to accept this project because we plan to recoup our initial investment within a period of 4 years. That does fall under our criteria that says any investment should recoup our cost in a time period of less than 5 years. Now, there are some shortcomings, some disadvantages of the payback method. As I mentioned before, it ignores the time value of money concept. So yes, that's $35,000 per year each year, but again, $35,000 received 4 years from now is not the same as $35,000 received today. Also, what happens after the payback period? We just focus on the payback period. We don't really talk about what happens after the payback period. A shorter payback period does not always mean a more desirable investment. What it does mean in this case that it does meet our criteria. However, buying the espresso board may not be the most desirable investment just based strictly upon the payback period. There are some strengths. It can serve as a screening tool because if it doesn't meet our criteria that we know, we're not going to accept that project. It identifies investment that recoup cash investment quickly. So we know that in our situation, we can recoup our costs within 4 years. Or it could identify products that recoup their initial investment quickly. So this is just a quick test to see, first of all, does this project even meet our criteria? And if so, what is the expected time frame to recoup the amount of our initial investment? Now, in our previous example, the cash flows were even $35,000 per year. However, that will not always be the case for every project. Sometimes you will have uneven cash flows. When that's the case, we can't use that formula. We just have to determine what time will it take us to recoup our initial investment. So for example, for this project, we have cash flows for 5 years, expected cash flows, but no, they're uneven cash flow. Okay, so we'll see how long will it take us to recoup our initial investment. So let's assume that our initial investment is $4,000. Our initial investment is $4,000. Once again, now we have uneven cash flows. So we're asking the question, how long would it take us to recoup our initial investment based upon these uneven cash flows? Well, let's take a look. 1,000 in year 1, 0 in year 2, 2,000 in year 3, 1,000 in year 4, and 500 in year 5. Our initial investment amount was $4,000. So based upon these time periods, it would take us, I'm sorry, I thought I showed you the response to that. Based upon these time periods, it would take us 4 years to recoup our initial investment because by the end of 4 years, our cash receipts would have totaled $4,000. Okay, that was the payback period. We will next look at a different method of determining whether to accept a project known as the net present value approach. So stay tuned for part 2 of our Chapter 14 lecture.